Hi guys, so good day everyone. Um, I'm Carlos Barola, base A student from Section B. So for today, I'm going to discuss about financial management, chapter 15, part 1. So the part 1 of this chapter 15 talks about the dividend policy, factors influencing the firm's choice, alternative dividend policies, determinants of dividends policies or policy rather. Three types of financial decisions influence the value of firm. So, dividend policy. So, as per definition, dividend policy determines the ultimate distribution of the firm's earnings between retention and cash dividend payments to shareholders. So, in other words, a dividend policy is the policy a company uses to structure its dividend payout to shareholders. So, in a very simple explanation, the dividend policy is a financial decision that refers to the proportion of the firm's earnings to be paid out to the shareholders. Here, a firm decides on the portion of revenue that is to be distributed to the shareholders as dividends or to be plugged back into the firm. So again, dividend policy refers to decision making. So to further clarify what is dividend policy, here is an example. So Kinder Morgan shocked the investment world when in 2015 they cut their dividend payout by 75%, a move that saw their share price tank. However, many investors found the company on solid footing in making sound financial decisions for their future. So in this case, a company cutting their dividend actually worked in their favor. And 6 months after the cut, Kinder Morgan saw its share price rise almost 25%. In early 2019, the company again raised its dividend payout by 25%, a move that helped to reinvigorate investor confidence in the energy company. So, where or in this particular example, where did we find or where do we find the dividend policy? So here, when the Kinder Morgan decides to cut their dividend payout by 75%. That is the dividend policy here. So the objective here is to raise more fund. And yes, to raise more fund and to make sound financial, to make of uh, finances financially sound. Okay? So again, dividend policy here is decision making. The decision of Kinder Morgan to cut their dividend payout by 75%. So we have the factors influencing the firm's choice of a dividend policy. So they are examined including legal constraints, restrictive covenants, tax considerations, liquidity considerations, borrowing capacity and access to the capital markets, earnings stability, growth prospects, inflation, shareholder preferences, and protection against dilution. So first is the legal constraints. So as per definition, in some jurisdictions, there are legal constraints on the distribution of a dividends. So a corporation is prohibited to distribute as cash dividends of a corporation's legal capital. This legal capital is typically measured by the par value of the common stock of a firm. So legal constraints, in some circumstances, the legal capital is also included paid in capital in excess of par or share premium. The purpose of this legal capital is to provide a sufficient equity base in order to protect the claims from creditors of a firm or corporation. Number two is the restrictive covenants. So creditors also attempt to limit stockholders' ability to transfer assets to themselves through dividend restrictions. Bond covenants that restricts dividends are necessary to protect bondholders against the payout of assets that serve as collateral. So in the extreme case, shareholders could vote to pay themselves a liquidating dividend, leaving only an empty corporate shell. Most dividend restrictions refer not only to cash dividends, but also to share repurchases. Payout restrictions generally require that dividends can be paid only from earnings generated subsequent to the borrowing or earnings above a given amount. Also, there are frequently restrictions on a borrower's ability to increase dividends from existing levels. So we have tax considerations. So shareholders are primarily concerned with the after-tax returns of their investments. So company pays taxes on its earnings prior to any dividend distribution, and investors receiving dividends do not pay taxes on dividend income. However, higher tax rates can be reduced the earnings of companies, and at the same time dividend is also lowered down. So as the definition says, the higher the tax rate, the lower the earnings and dividend of a company or a firm. So in some government, no, especially outside the Philippines, particularly in India, they imposes dividend distribution tax. As a result of all these, shareholders prefer relatively lower cash dividend because of higher tax to be paid on dividend income, and opt for capital gains to dividends because capital gains are usually taxed at a lower rate. So they make alternative for that because individual man, it's an individual obligation for them to pay tax if there is dividend distribution. We have liquidity considerations. Generally, dividends are paid in the form of cash, hence it entails cash. Although a firm may have sufficient profits to declare dividends, it may not have sufficient cash to pay dividends. Thus, availability of cash and sound financial position of the firm are important factor in taking dividend decision. So again, the liquidity of a company depends very much on the investment and financial decision of a firm, while in turn determining the tax rate of expansion and manner of financing. If cash position of a firm is weak, stock dividend will be better, and if the cash position is good, it can go for payment of dividend by cash. So again, liquidity consideration. We have borrowing capacity and access to capital markets. So access to capital markets here does not refer to a road, no? Access to yan, no. It does not mean the way or the path of going to capital markets, but instead it is um, it is the way, way of a certain firm to raise funds from the market. let's say for a concrete example, no? In a sari-sari store, although sari-sari store is not a corporation, but the owner of sari-sari store uh, frequently relies on its customer. It's because usually capital or uh, additional capital raised from sari-sari store are utilized, no? Utilized for additional capital. So, in other words, sole proprietor or the owner of um, a certain sari-sari store will rely on its customer. So, customer here is the capital markets. So, that is the access to capital markets. So, again, one of the good example of capital markets are the customer. We have here earnings is stability. So it's very easy to determine how earning stability will affect the dividend policy. Of course, the will affect the dividend policy because if there is stability of earnings, then we can say or we can probably say that there is a stable dividend payout. So it's upon depend of on the entity or a firm if they will go on to the stability of dividend payout because of earning stability, or because of growth prospects they will cut, no, the dividend payout because growth prospects. Number one example here is the franchising activity of the Jollibee. So Jollibee is an entity who has um, make franchise not just here in the Philippines but also in other countries as well. So in developing their franchise in other countries, number one number one way or the key for them to make that possible is either to cut their um, dividend payouts or to just lend or borrow additional fund from the market. So that is the effect, no, of growth prospects to the dividend policy. We have inflation. So yes, inflation because let's say for example in a manufacturing entity, no, a manufacturing firm. So if there is inflation, there's also increase of price of raw materials. So if there is an increase of the price of the raw materials, then probably the manufacturing entity will cut their um, dividend payouts just to raise additional fund in order to sustain the manufacturing activity of the firm. We also have shareholder preferences. Legally, the board of directors has discretion to decide the distribution of the earnings of a firm. The shareholders who are legal owners of the firm appoint the board of directors. Hence, directors have to take into consideration owners' preferences while deciding dividend payment. Shareholders' preference for current dividends or capital gains depends on their economic status and effect of tax differential on dividends and capital gains. So in other words, shareholder preferences affect the dividend policy because the board of directors, as the as part of the entity's legal body, has to consider the shareholder preferences in declaring or declaring dividend policy. We have protection against dilution. Unsurprisingly, dilution has the opposite effect on a company's earning per share to buybacks. An interesting example would be a company issuing new shares to finance its growth project, which can lead to higher profits. But because the total number of shares outstanding has gone up, the company's earning per share would increase by a smaller amount. In fact, it is possible for a company to report higher overall net income but lower earnings per share. Furthermore, stock dilution can also lead to higher dividend obligation for the company. So, aside from those mga factors, we also have alternative dividend policies. So, alternative dividend policies include passive residual approach, stable dollar dividend approach, constant payout ratio approach, and policy of paying a small regular dividend plus year-end extras. So first is the passive residual approach. So in this policy, if the firm has earnings left after financing all acceptable opportunities, these earnings would then be distributed to shareholders in the form of cash dividends. If not, then there would be no dividends if the number of acceptable investment opportunities involves more amount than the retained earnings. Then the firm would finance the excess needs with a combination of new equity capital and debt. Let's say, for example, a company has equity capital of 100,000 pesos. 100 million pesos day. No. 100,000 pesos na. Comprising, again, 100 million pesos na. Comprising 10 million shares. If earnings of the company after payment of interest and tax are 28 million pesos, and the company has investment opportunity of 20 million pesos, then the company would pay 0.8 per share as dividend. So again, dividend share or dividend payout relies upon the dividend policy. So it is up to the board of directors whether they have to pay sa dividend payouts. Next is the stable dollar dividend approach. So a stable dividend policy is the easiest and most commonly used. The goal of the policy is a steady and predictable dividend payout each year, which is what most investors seek. So whether earnings are up or down, investors receive a dividend. So kini pud nga approach mo ni kasagaran mo or it is usually the refers the stockholders choice, no? Mo na ilang ganahan because it favors their side man. Because although it doesn't matter how the company earn money. What really matters here is that there is constant distribution of um, dividend payouts. And we have constant payout ratio approach. So a constant dividend payout ratio policy is a dividend policy in which the percentage of earnings paid in the form of dividends is held constant. In other words, a constant dividend payout ratio policy maintains the same proportion of earnings paid out as dividends to shareholders. So the primary drawback of the stable dividend policy is that investors may not see a dividend increase in boom years. So under the constant dividend policy, a company pays a percentage of its earnings as dividends every year. So in this way, investors experience the full volatility of the company earnings. So there is constant payout ratio of dividend na kanunay every tuig. So the shareholders will enjoy eh, uh, the proportion which has been paid because of the dividend policy. And then we have policy of paying a small regular dividend plus year-end extras. So when profits of the company swell, the management may decide to distribute a part of the increased earnings as to extra dividends instead of enhancing the regular dividend payout ratio. So companies following regular dividend policy pay dividends constantly to stockholders at constant rate and do not change the payout ratio unless it is believed that changes in earnings are permanent. So when profits of the company, again, matawagin on, extra dividends are declared only in the year in which earnings exceed annual dividend requirement by some given amount. Next, we have determinants of dividends policy. So dividend policy determines how the earnings of a company are distributed. Earnings are either retained and reinvested in the company or are paid out to shareholders. In recent years, the retention of earnings has been a major source of equity financing for private industry. So determinants of the dividend policy, daghan na sila. But I may extract no 10 lang important para na ho. So number one is type of industry, age of corporation, extent of share distribution, need for additional capital, business cycles, changes in government policies, trends of profits, trends of taxation policy, and future requirements, and also cash balance. So there are also three types of financial decisions influence the value of firm. We have investment decision, financing or financing decisions, and dividend decisions. We have investment decision. So it is more important than the other two decisions. It begins with the determination of the total amount of assets needed to be held by the firm. In other words, investment decision relates to the selection of assets on which a firm will invest funds. So we all know that investment is the soul, can be or correct me if I am wrong. For me, investment is the soul of a corporation because investment is the source of capital. It is uh, investment is part of the entity's asset that will be utilized as capital. So without investment, of course, corporation or entities or firms cannot sustain their necessities to, to remain as such. So number two is financing decision. So after estimation of the amount required and selection of assets required to be purchased, the next financing decision comes into the picture. Financial manager is concerned with makeup of the right-hand side of the balance sheet. It is related to the financing mix or capital structure or a leverage. Financial manager has to determine the proportion of debt and equity in capital structure. So of course, right after na natin mga investment, na natin capital. So all we need to do, no, as a corporation is to make budgets. Of course, let's say for example, sa atong mga day-to-day living na to, no, life na to. As if one mo observe, no, our mother always make budgets for the expenses, no, of our daily expenses. So like the corporation, managers are responsible, no, for financing decision. They are responsible for budgeting. And then we have dividend decision. So katong dividend policy kani related is just a dividend decision. So this is the third financial decision which relates to the dividend policy. Dividend is a part of profits which are available for distribution to equity shareholders. There are two options availing in dealing with net profits of a firm. Distribution of profits as dividends to the ordinary shareholders where there is no need of retention of earnings, or they can be retained in the firm itself if they are required for financing of any business activities. So kani-gani ha, as I said earlier, duhara na ang dividend policy. You're going to have dividend payouts, or going to cut the dividend payout. Purpose of cutting dividend payout is to raise more capital, especially for growth prospects. Now, so I think that's all. Thank you very much for listening. I hope you learn a lot. You learn a lot from my discussion. And again, stay safe, everyone. Special thanks to our teacher, Sir TJ, and God bless us all. So, mabuhay tayo lahat. Goodbye. Thank you very much.